equity, part 1. Problem 1. You have the following data for Mabigita company for the year ended. And the question is, what is the total shareholders equity of the company? So based on their information, so we have your authorized share capital. So authorized share capital is 5 million. So if the company is authorized 5 million, and at the end of the year it's unissued, share capital is 2 million. So that means the issued share capital for the year is 3 million. I put here. Authorized minus unissued equals issued share capital for the year. So, okay, done. Then you have subscribed capital share. Subscribed share capital. Subscribed share capital is 1 million. Minus our subscription receivable, which is 400,000. So that means the net subscribed capital is 600,000. If the problem is silent, subscription receivable is assumed to be not collectible within the year. If it's collectible within the year, this is shown as current assets. If not, it is shown as deduction from subscribed share capital. So you have issued and outstanding. Then we have share premium. Share premium of 500,000. So you have shares issued plus shares subscribed. So shares issued and outstanding plus share premium, that is called the paid-in capital. So share premium, then you have your retained earnings unappropriated. So retained earnings unappropriated, these are retained earnings not specifically designated, for example, for treasury stock acquisitions, for plant expansions. So unappropriated, meaning this is available for distribution to stockholders as dividends. So retained earnings unappropriated, you have here 500 share premium, 600,000. You also have retained earnings. Retained earnings appropriated. Appropriated. Though it's appropriated, it is still part of the total stockholders' equity. So 300,000 is still part of our computation. Then you have revaluation surplus. When our assets are acquired from a long time ago and its fair market value has increased significantly over the years, so you can have it revalued, but that's another discussion, and please watch out for my video on the revaluation increments or revaluation surplus. So for now, it's included as part of the total stockholders' equity. So revaluation surplus, 200,000. Treasury shares is also part of our total stockholders' equity, and it is shown as a deduction. Treasury shares at cost, which is 100,000 deduction. Treasury shares are companies' own shares that are reacquired but not cancelled. So minus 100,000. So our total is 5,100,000. That's our total stockholders Stockholders equity. So that's our answer for problem 1. Stockholders equity, problem 2. The question is, what is the amount of legal capital for Coronadal Company? The amount of legal capital differs from one company to another if one company issues with par value versus with no par value. When you say par value, that's the minimum amount that a stock can be subscribed, written in the articles of incorporation. If it has no par, a stock can be issued with its stated value. When it has no par, the legal capital is equal to its stated value plus the excess over the stated value paid by the stockholders. So that's the total legal capital for a company that has no par value. For in this case, Coronadal has par value for a stock. So we will just take the par values of preference shares, 2,300,000. Then you have ordinary shares, which is 5,250,000. So preference shares. Share premium, excess over par is not counted as legal capital for, again, stocks with par value. So for share premium here, it's out. Ordinary shares counted. Subscribed capital shares, of course, it's counted. Subscribed capital, which is 50,000. So subscribed capital of 50,000. So our total legal capital is 7,600,000. So in case of a par value shares, its legal capital is the aggregate amount of the par of its preference as well as ordinary issued and subscribed. So subscribed capital is counted. Stockholders equity, problem 3. Accounting for stockholders equity, problem 3. The question is, what amount should the share premium amount increase as a result of this transaction for Quarantino? So Quarantino issued 1,000 shares with 5 pesos par value distancing as a compensation for 1,000 of professional services performed. As a rule, when we issue shares, we record that transaction based on number 1, in the priority of recording is number 1, the fair market value of the asset received. Then, if that's not available, we record the fair market value. We record the transaction of the fair market value of the shares at the time of the transaction. And if these two are not available, number 3, we record the transaction of the par value of the shares. So, in this case, what amount should the share premium amount increase? Distancing usually bills 180 per hour for professional services. The question is this the fair market value of the professional service rendered? Because if this is the fair market value, we will record the transaction at 180 times 1,000, so that's 180,000. But normally, when professional services are rendered, this billing are negotiable. So since it's negotiable, that doesn't count as the fair market value. So the safest is the share was taken on a public exchange. So public exchange, that's the fair market value of the shares. The fair market value of the service is not available, so let's go to the second option, which is the fair value of the shares issued. So our entry to record this transaction is debit professional services So at 150 per share, so 150,000. 150,000. We got that from 150 fair market value of the shares times the shares issued. 1,000 shares. So then with professional services, 150,000 credit issue share capital. It is always a par, so 1,005 pesos. So that's 5,000 in credit, share, premium 145,000, the difference. So 145,000. So as to the question, by what amount should the share premium account increase? So our answer is 145,000. Accounting for stockholders' equity. Problem 4. Requirement is to journalize the transaction. At the beginning of the current year, Point Check Company issued 10,000 ordinary shares for 20 par value and convertible preference shares with par value for a total of 800,000. This is a lump sum transaction, lump sum selling of ordinary shares and preference shares. So if it was sold for 800,000, how do we allocate for the total ordinary shares and the total preference shares? Given that at this date, their market value, given at this date, the ordinary shares market value is 36 and preference shares is 27. So at that date was 27. So how do we allocate that? So we get the market value. So we have ordinary and preference shares. Market value. For ordinary shares, the company issued 10,000. 10,000 times 10,000 ordinary shares selling for 36. So times 36. That's 360,000. The preference shares on that day, 20,000. We issued 20,000. Market value 27. So times 27. So that's 540,000. 540,000. So this is 900,000. To get the fraction, you'll just take out the common zeros. Common zeros. 4 zeros, 4 zeros here. So it's fraction. This is the numerator, this is the denominator. 36 over 90, and you have 54 over 90. Then, for the allocated price, the total price to be allocated is 800,000. So 800,000 times 36 over 90. 800,000 times 36 over 90, that's 320,000. Again, do not squeeze the figure. Let that be our check figure later. So 5490 times 800,000, that's 480,000. So we added 20 for ordinary, for 80 for preference shares. So to answer, journalize the transaction. Our entry is debit cash. We received cash 800,000. The total value we received 800,000. Preference shares always at par. You have 20,000 at 20. Preference shares 20,000. Par value 20. So you have 400,000. It was issued at 480. So therefore it's share Premium, preference shares, 80,000. 400 par, issued at 480. APEC or share premium, 80,000. Ordinary shares, 10,000 at 20. So 10,000 at 20. 200,000. 200,000 issued at 320. So share premium 320 minus 200, 120,000. So our entry is debit cash 800, credit preference shares 400, share premium on preference shares 80, ordinary shares 200, and share premium on ordinary shares 120. That's our journal entry for this transaction. So, to recap, when we sell stocks for a lump sum price, we allocate, if all of these stocks, its market value are available, we compute the total market value for that shares issued, then generate a fraction by canceling out the common zeros and multiply that fraction you get from the second step, multiply to the lump sum price to get the allocated price for each shares of stocks. So that's how we get this journal and figures. For stockholders' equity, problem 5. The requirement is journalize the transaction. At the beginning of the current year, Lock Company located and issued 6% bonds together with an ordinary shares of 50 par value for a combined cash of 11 million. So again, this is a lump sum selling of our shares, but this time the combination is an equity and a liability, a bonds payable and ordinary shares. The question is, how much are we going to allocate for the bonds and how much are we going to allocate for the shares of stocks? So we will journalize the transaction. Previously, we created an allocation based on the market value of the preference shares and the ordinary shares. The problem is only one of the two items sold has the market value, which is, if given here, if issued separately, the bonds would have sold for 4 million. So that's the market value of the bonds. So if only one among the two has the market value, so we will allocate first the no market value. So this is the combination price. Which is 11 million. And so we will deduct the market value of the bonds, which is 4 million. Therefore, the allocated price for ordinary shares is 7 million. 7 million. So now we can journalize. Our requirement is to journalize the transaction. We receive, so debit cash 11 million. Okay. Bonds and ordinary shares should be recorded at par. Bonds 4 million. Bonds with a maturity value of 6 million. So credit bonds payable 6 million. Have here bonds payable 6 million. Bonds payable are 6 million. Allocated price is 4 million. Therefore, we have a discount on bonds payable of 2 million because we sold the bonds at a price 2 million lower. The allocated price is 4 million. So credit 6 million bonds payable, debit discount on bonds payable of 4 million. Then we will record ordinary shares at par. So credit ordinary shares, which is 10,000 at 50. So that's 500,000. 500,000 for an allocated price of 7 million. Therefore, we have share premium on ordinary shares of 6,500,000. So debit cash 11 million. Discount on bonds payable 2 million. 2 million lower. Bonds payable 6 million. Outstanding shares 500,000. 10,000 at 50. And the difference 7 million minus 500. Share premium of 6,500,000.